I welcome everyone. I'm Sudhir Pandey. I welcome you to Ahmedabad University and to the conversation series. Ahmedabad University is a research university and we believe in a different kind of education. Our pedagogies are entirely different and we believe that for the new age, new pedagogies are required and we believe strongly in the interdisciplinary kind of education. And this is the reason that beyond classroom, we provide certain opportunities to the student and to the wider society. Conversation series is one such opportunity. Here we invite deep scholars and policymakers from the area, and an in-house faculty engages with them. Today we have one such eminent scholar with us. We have today with us Professor Amartya Lahiri, and it is an absolute pleasure for me to introduce you, Professor Amartya. Professor Amrut is the Director of Graduate Studies at the Vancouver School of Economics, University of British Columbia. He has held research positions at the Federal Reserve Bank of New York, University of California, Los Angeles, and Johns Hopkins University prior to joining University of British Columbia. He is also Royal Bank Faculty Research Member as well as the Johal Chair of Indian Research with the Institute of Asian Research. Dr. Amartya is a member of American Economic Association and the Econometric Society. He is also an associate editor at the European Economic Review and Journal of International Economics. Dr. Amartya's field of specializations are international economics and macroeconomics, and he has written extensively on these topics, and he loves to research in this area and write policy papers. So we are thrilled to have you at Ahmedabad University, Dr. Amartya, and welcome again. Thank you so much for joining us. The person who will be in conversation with Professor Amartya is Professor Amol Agrawal. He is an assistant professor in the economics and public policy area at Amrut Mody School of Management, Ahmedabad University. He's a PhD in economics from IIM Bangalore. Before his PhD, he worked as an economics and financial market researcher in Mumbai for a long time. He runs a blog, which is a very famous blog named Mostly Economics. Recently, he has been asked by the Department of Financial Services, Ministry of Finance, to advise them on documenting the history of Indian banking on the occasion of 75 years of Indian independence. So good to have both of you. Before I hand it over to you, I request all the participants, you'll be muted, and I request you to put your questions in the chat box, everyone's chat box, while the conversation will be on. And we'll take all your questions and then we'll put all the questions at the end of the conversation during the Q&A. And throughout the conversation, these two speakers' videos and audios will be on, and that's how it goes. So thank you so much for joining us. I request Professor Amol Agrawal to take it forward.
Thank you, Professor Sudhir, and a very warm welcome to Professor Amol Lahiri, and who have been reading his columns and so on and so forth. So it's a delight to speak to you, Professor Amartya, and a very warm welcome to all the students and all the other visitors for this conversation series. So before we get to the topic, Professor Amartya, you have a very interesting background. You've dabbled in both economic, academic research, and also policy research with the Reserve Bank of India and also with the Federal Reserve. So can you take us through your journey in brief, and also discuss the differences and similarities between academic and policy research?
Hi, Amol. Thank you very much for this very warm and Professor Pandey for those very warm and welcoming words. It's a pleasure to be with all of you. So I guess in a nutshell, I mean, I started my academic career at after I finished my PhD, I was working at the university at UCLA. So it was, for the first 8-9 years of my, academic life, it was all research was, essentially pure academic research. But I worked in an area which is, you might call it applied theory. So, there is, when you're doing things in, especially my kind of research, which was mostly in macro and international economics, international finance. So I was working in areas which spanned some, macro development, macro growth, and international finance, which is what I was doing a lot of. So those are applied theory. They are not pure theory. So applied theory really is much closer to policy than pure theory can sometimes be. because you're motivated by evidence, and then the theory has to be validated by the evidence. So you're going back and forth, and usually questions come up that are interesting in the in applied theory, which are interesting questions are often responses to policy challenges or things that have come up in so in the a lot of my early work was on balance of payments crisis, which is what I was doing, and that had its origins in the Asian crisis that happened in the late 90s, and that created a lot of interest. So I was that was a big clearly it was a policy issue. There was a very well-defined policy issue, but you had massive interest amongst academics as well of this applied policy, applied theory kind of bent of mind. So in some sense, it wasn't that big a change for me when I moved to the Federal Reserve Bank of New York. It was not like as if my research changed. I continued doing this academic research, which most of the research departments at the Feds, at the Federal Reserve, central banks, whether it's the ECB or whether it's the Bank of England or the entire Federal Reserve System, the essential research function is performed by people in the research department who part of the time they're doing policy work, but when they're writing research papers, they're actually competing for journal space with academics from who are on campuses. So that component of research is shares a lot. So academics like me, when we were now, we pay a lot of attention to what's coming out from the research departments, and are informed in questions and in approaches. And the same with the researchers in research departments. Are clearly using state-of-the-art methods, which are the same things that are being used. The main difference between academics and a policy institution is what you do in the time that you're not doing this research work, which is competing for journal space. So as an academic, the rest of the time is teaching, which is your main focus, and there is a close correspondence between what you teach and the stuff you are working on in terms of your research. So in other words, if somebody is working in macroeconomics, he will typically not be asked to teach micro theory or something. So there's like a close correspondence between the work you're doing in terms of your research and what you are asked to teach in the classroom. In the context of policy institutions, sometimes there is a bit of a delink between what you are working on research in terms of your research and what you are asked to do because when you're in a policy institution, you're not teaching. So what are you doing the rest of the time? That is really very sort of day-to-day or immediate policy-related issues that you're covering, which is what, say, for example, I was doing at the New York Fed. It would be, that's the basic structure. Is you do bank work. Bank work is policy work on a much more immediate basis. That a report has to go out. There is a BIS meeting, so we need a report on what's happening in banking. So these are not necessarily academic papers, but it involves a lot of background work. But so these are policy reports almost, which sometimes inform speeches by the bank president, and internal, their feedback on tracking data as feedback into forecasting. There's a lot of focus on forecasting, but how do you, interpret some high frequency data and that sort of. So this is the balance of time that goes by. So as I see it, at least in in the research departments of the kinds at a lot of central banks around the world, the difference really is academic research. I think academics and those guys doing the same things. I mean, very, very similar stuff. I mean, a bit more focused on directly policy related questions, but there's not that big a difference. The difference is what are you doing in lieu of not teaching, and that is really this high frequency stuff. So that can be really exciting because stuff is landing on your table on an ongoing basis. I mean, every morning sometimes is a crisis. You get to think very quickly. I mean, it's a bit like the example I like to give is a lawyer who's never practiced law in some sense is and stayed always on a campus teaching. At some level, the training is not complete. That you
Right.
kind of have to go and at least if you're doing applied theory related work, it's good to sort of also have that very very. So it rounds you off. So it was very exciting. I mean, I found that stint exciting.
Okay. Wonderful. This was quite interesting. You've taken me back to my own sort of days in Mumbai where we used to be dealing with these policy matters, though I never really worked in a policy research sort of work. But anyways, so now let's come to our conversation topic, which is the current banking crisis. And as I was going through your work and also to the students and the audience here, it's perhaps we can't jump to the current banking crisis without really getting into some history, because here we're talking about public sector banks and private sector banks. And this typically started in 1969 when the Prime Minister Indira Gandhi nationalized the 14 largest private banks. So can you take us through this history and what led to the nationalization? What was good and bad about nationalization? And I was also looking at your research in in your recent research on banking, where you pointed out that there is presence of public sector banks in several countries, and you've got this very interesting table. So if you could just tell us that, did the other countries also nationalize banks, or they just created public sector banks?
Yeah. The Indian history of nationalizing banks, I think, I mean, we did bits and pieces of it even just after independence. I mean, the State Bank actually was one of the first ones to, get nationalized. But then its subsidiaries kind of but taken over sort of later. But I think the main thing that happened in India in the 60s was, I mean, the 60s was a tough decade for India. I mean, we had suddenly we had two wars. We were fairly closed. We had like issues with agriculture. So we had multiple droughts, and we were fighting for just trying to feed people. And there was, so the challenge always was that how does one, development was clearly the goal, but the 60s seemed like we were struggling in a major way. So there was this notion that even other countries who had bought into this idea of a sort of command and control way of industrializing the economy were beginning to revisit some of those models in the mid to late 60s. I mean, Korea was one of the early ones that around that time decided that maybe a rethink is required, and starting to go the privatization route. So with Mrs. Gandhi, I think in the mid 60s when she came on, I mean, actually under Lal Bahadur Shastri, there was the starting of some degree of trying to remove the command and control things,
Yeah.
but he was not there long enough. So, and then once he left, Mrs. Gandhi came, but instead of continuing on the somewhat baby steps that were begun under Lal Bahadur Shastri, she went the other route and said, well, we are going to, I'm going to nationalize completely. Some of this had, her response was, had a lot of political reasoning rather than sort of deep economic, policy model reasoning. I mean, so it seems that at least at the time, the political factors driving it had a lot to do with trying to neutralize a bunch of industrialists who were seemingly with the opposition or people who were not supporting her. And so this was it had this aspect of trying to cut off some of the opposition at its knees by removing their asset holding. But on top of that, I think there was a genuine notion that somehow what we need to do is development requires going into dealing with agriculture, trying to boost agriculture, trying to penetrate the vast rural landscape of the country, which was where 85% of the country was staying at the time, was living at the time. And the private banks just were not interested in going in there. And so there was this notion, and agriculture was something that, has been always a big issue, that, India, we have lots of slogans around, farmers, we have elections being fought on farmers. So the optics of all of that, saying that this is all done to, try to make sure that credit gets allocated towards priority sectors, and priority sectors, agriculture is a big component of that. And then the other bit was, are we doing enough for small? So, I mean, most of our entrepreneurs are small, and are they getting enough credit from the private sector? So those were at least the two big selling points of the time, along with this political backstory, which about, just trying to neuter the industrial opposition to her. And so that was the background. But what is interesting is, if you look at, clearly, rural penetration of banks did pick up in the 70s. There was a huge pickup. But, there's sort of interesting work done by different people who find that, the big expansion of rural branch, holdings was actually done by the private sector banks at the time, rather than their rate of rural expansion was quicker than the public sector banks, which was because when she took everything, when the 1969 nationalization happened, I think it was 54% of all bank branches became state-owned at that point. But then this further penetration into rural areas, the growth of rural bank branches, or opening of rural bank branches, was quicker for the private sector guys than banks then. And then, of course, we had a second round of nationalization in 1980 or 81, I forget, but it was another 6 banks were taken over at the time, which took the share to, close to 90 or 94% of overall banking, or bank branches became state-owned. But that's the history. I mean, it was really trying to, at least the goal was to deal with, sending credit to where the state thought were its priorities, and the priorities were small scale industry, small entrepreneurs, niche exports, and farms and farmers, how to deal with farmers. And that was at least the primary goal for that nationalization.
Yeah, and what about the sort of global experience with your table on?
Oh, right, yeah. Most big episodes of nationalizing banks, India's is one of the bigger ones, I mean, that ever happened. The other cases are actually Mexico, where Mexico, it happened in I think 1982, when the world was Mexico was stuck in a massive debt crisis. So Mexico defaulted on its international debt. Right. These banks had pretty much were all floundering and going. So, it's almost like, injecting capital into recapitalizing the banks, but recapitalizing the banks by, you can argue that, people were proposing the same kinds of things in the US after the financial crisis, when a lot of the banks were really stressed, the big guys. So some of the capital injection, or the capital injection into the auto industry. So a lot of people began to call that, like, nationalization through the back door in the US. But the Mexican thing was really a response to, it was officially nationalized, the state took them over, and that was 1982. Similar thing happened in Israel, I think in 1983 or 84, where, about 4 or 5 of the biggest banks got taken over. Mexico, of course, began to walk it back, starting the mid-1990s. They began to nationalize. Israel, sold off, I think 1 or 2 of those were privatized, and the rest, they began, just like the Indian PSBs, they began selling, shares to the private sector. So you dilute state ownership, but you don't get rid of controlling ownership, you dilute it. Latin America in general, I think El Salvador, Nicaragua, I mean, there have been, examples of nationalization. Bangladesh is another case of pretty of nationalizing existing private banks, which happened in a. But most of the others actually started with some. I mean, it was like state set up banks, and then the issue becomes, should we sell it off or not, or that was a bit different from going after private property and just taking it over. So that India was somewhat, I mean, not alone, clearly, as I said, with these examples, that there were others. The same thing happened in the US after the saving and loan crisis, actually, where a bunch of small, credit corporations basically went under or started defaulting. And so they were basically absorbed into, under a big charter, entity, which was a government entity, and essentially were nationalized. But most of the difference between what happened, I mean, there have been other cases. I mean, so again, Finland, Sweden, both these countries after their early 90s banking crisis, they actually did take over a bunch of banks. But most of that response was both temporary and most of these examples, I mean, of nationalizing a state takeover of existing private banks is in response to some banking crisis, not a generic model of socialism which says that I'm just going to take private property and convert it into state-owned. So that's a somewhat different thing that the Indians have done. That India did in the late 60s was really just going after private property. As I said, Bangladesh did it. But even Mexico, it was responding to a banking crisis. Finland, Sweden, Israel was caught up in a bit of a banking crisis. Israel's case is somewhat bit mixed. I mean, there was a real commitment to socialistic views in socialist model in Israel in the 80s. So it was a bit different from what it is now. But our motivation was completely different, right. And as a result, you see the state ownership of banks owes its origins mostly to nationalizing rather than the state having set up banks to start with and then just running them, which is the case in most of those. The table is pretty long, right. But most of the others actually have they created some of these banks.
Yeah, I mean, as I was doing my own sort of research on this, I realized that France also nationalized its banks with much like the socialism objectives in the 1940s and the 1980s. So I think looking at all this evidence, I think France and India are very close to sort of the way they went around nationalizing with socialist sort of outlook. Okay, so
France, I think, did this Credit Lyonnais. No, that was the big thing.
Right,
that was in the late 80s. Yeah.
So let's obviously we can't leave away the 1991 reforms when we compare the Indian banking or Indian economic history, and we are also looking at the 30 years of banking. Indian economic reform history. So this is the 30th anniversary. A lot of talks, a lot of discussions. So what changed for Indian banking in the 1991 reforms? Some discussion on that before we move on to the current crisis.
Yeah. So the 1990s, as we all know, the 1991 reforms were an epochal change, or a real state shift in a lot of business operations. In particular, it was this growth of private enterprise, which it facilitated as entrepreneurship kind of began to take off as people saw that people weren't trapped in whatever they were doing. There was scope to grow. There was scope to expand into sectors that previously they couldn't unless they knew people on the inside and so on. So there was this growth of entrepreneurship, which, of course, I'm speaking to a big audience which is located in Ahmedabad. I know people from outside, but I mean, entrepreneurship is so deeply ingrained in almost, in the Gujarati mindset that, Ahmedabad is a great place to see entrepreneurship. I mean, but in the rest of India, it was the post 1947 period was a bit of a chilling period for entrepreneurship because it was the model that that was being proposed was not necessarily viewing entrepreneurs as friends of development. It was like, this notion that somehow entrepreneurs are, their interests are not always aligned with development and growth. I find Gurcharan Das's writings on this very, very, very interesting about. But what the 1990s, after the reforms, I mean, entrepreneurship suddenly became, not a bad thing to do. And in general, people from backgrounds that, had no family background or business, etc., began thinking of setting up businesses and so on. So it brought into the entrepreneur landscape a lot of middle class people. But that growth was happening, so a lot of borrowing therefore began to take off. I mean, the credit markets began to extend. There was this gradual opening up of, or lending that happened. Demand had really taken off. So there were these teething problems. So we had a crisis in banking in the late 90s in India, which was a booming and a big NPA crisis that had happened, which sort of brought, I think was really the outcome of the banking sector and the credit culture essentially taking root, but not having all the institutions in place. So there was growth, but we had interest rates that were still high because the economy was fairly, inflation was high, interest rates were high, and they would be moving around. So, and then came the Asian crisis of the late 90s.
Right.
So as interest rates got, moved up very high, very quickly in response, we had this a bunch of lending that had happened without credit ratings, credit history, all of this stuff was still in a very nascent stage.
Right.
So what ended up happening, I think, was, bad debt will kind of build up in the system, or NPAs built up in the system in response to the economy opening up. And therefore, I mean, there were people who did want to borrow. There were businesses that were looking at expansion, but it, the credit landscape, I don't think had developed fast enough in response. So these are these initial teething issues that happen when, so I kind of view the 1990s crisis more as the banking system and the credit system kind of developing its own institutional structure in order to better, appraise loan candidates, to better figure out who the borrower is. And a lot of that used to be so controlled up until that point that even the big borrowers were all state origin borrowers. So the 1990s crisis, was really, the NPA crisis was, the growth induced by reforms, but without the credit institutions developing fast enough. And so stories of how, how people were recovering loans at the time are, has nothing to do with modern banking. I mean, you would send, armies of hooligans out to repossess. So we didn't have Sarfezi, we didn't have. So the banks were stuck with. It was a landscape which was trying to modernize and trying to catch up. I mean, so it was an issue of, I think, the demand side moving much faster than the supply side in terms of how the system was changing, and as a result there were teething problems. I think that's how I view the 90s. The 2000s, the 2008, the current NPA crisis, which sort of, you can see originated back in the early 2009, 10, 11, around, that period kind of took off. That its origin is a bit different than the 1990s one. So, I mean, I think just to put the 1990s, really the reforms generated a huge thing, but this was some sort of a collateral damage kind of thing that happened at the time, because the credit landscape was, I mean, you development is often not easy. It's you learning how to do new things which you didn't do earlier, and what we saw then was really an outcome of that.
Yeah, just amazing, to go through this sort of history, and so now we to the current crisis. As you said that this is slightly different or very different from how we sort of saw earlier banking crisis. So what led to the current crisis? In your research, you pointed out that political goals were a key driver of public sector bank loans, and these loans were primarily going to the infrastructure and social sectors, which in turn led to higher NPAs. So can you take us through this research of yours and where, how do you connect the dots between political goals, loans, and infrastructure lending, and what that led to, and yeah.
Yeah. So the way, I mean, let me sketch it out in a, this is what I'm going to say is clearly, based on what I've looked at in a couple of papers. But the way I see this is there was this massive, let me give a little background. So if you look at NPAs in India, you can ask, how do bankers, lend? What are the things that they're lending to? So in a system that is working well, you should see that, NPAs, if, which sectors are NPAs very high in, they should be, or put differently, NPAs should be low when productivity is high. I mean, generally there should be a negative correlation. You should see loan growth, even if bankers are doing their job properly, loan growth should be positively correlated with sectoral productivity. So in other words, loan growth, NPAs, profits, etc. So they should all somehow be correlated with productivity of the firms that you're lending to, right? So if you look at the way Indian the performance of loans in India, you sort of ask, where are the loans that if you break up the countries by sector, you find that NPAs and productivity are indeed negatively correlated for most sectors, except for about 3 or 4. And these sectors happen to be the most infrastructure linked sectors, the ones where, it goes counter, right? The NPAs are high when productivity is high, which is sort of the other way. Then you say, okay, where are the sectors where loan growth is happening, is the highest? Again, if you start looking with, sectoral productivity, you would expect that, when sectoral productivity is high, that's when loans, people demand more. So, and banks should be lending more to those sectors. Again, true for almost the entire landscape, except for the same 3 or 4 sectors that are linked basically to infrastructure. I mean, so there are like 4 or 5 different metrics. I mean, so then you look at efficiency metrics. I mean, you kind of, to get just slightly technical, I mean, you might want to say that efficient lending should be where the additional, bang for the buck that that a loan is getting is somewhat equal to close to what the cost of funds are. I mean, so there's some sort of mapping between them. And if there's any gap between what the additional bang for the buck, if you invest in that sector, is and what the cost of funds are, that's like a wedge. I mean, there is some systematic wedge. Now, there could be a wedge, but does the wedge move very, in systematic ways? So what you find, of course, is that these wedges are, of course, fairly muted in most sectors, except for these 3 or 4 sectors that I discussed earlier, which are these infrastructure-linked sectors. And again, what happens there is that, you have, huge wedges, which says that there is a delink between what the cost of funds are and what the additional bang for the buck is by investing in those sectors. So, the balance of all of that information sort of got us to start thinking that this is, by the way, I mean, joint work with someone who used to work with me at CAFRAL, but she's now at the Federal Reserve Bank of Richmond, Urvi Neelakanthan. So what we found was we started looking a little deeper into what exactly is going on here. Why is it that everything is kind of backwards for these guys? Everything else seems fine. And indeed, I mean, you can look at Indian banking overall and ask, what is the relationship between loan growth and NPA growth. So if you think, I mean, they're using sectoral data and just how much loans are growing in each sector and what is the growth of NPAs, what you would expect to see that if, if loans become non-performing, just by random, there are, bankers, of course, when we lend funds out, you're going to make mistakes. Not everything is going to work out. And so those are just, random. I mean, you shouldn't be making systematic errors, right? So if a banker is doing his job, it would be the case that loans do, become non-performing, but they don't become non-performing in a very systematic way. That you sort of, sometimes, there are just things you didn't pick up, some bad luck hits the borrower, so you'll have non-performing loans. So on average, the sectoral distribution of NPAs should be similar to the sectoral distribution of loans. I mean, that, you shouldn't have this systematic difference. And what you find is that sectors that have a larger share of loans do have a larger share of NPAs, which is what you would expect. But where this mapping based, completely breaks down, or there are 3 or 4 outliers where the sectoral share of loans and the sectoral share of NPAs is an order of magnitude greater than the sectoral share of loans. And those are, again, these 3 or 4 infrastructure sectors. So, so that kind of got us into this thinking hard about what exactly is going on in this landscape. Why are these sectors recurrently, seemingly, showing strange, strange behavior? And I think to understand this, one has to go back to what got us into it. So what happened, I think, in the the early 2000s or mid 2000s was this recognition that a massive boost in infrastructure investment is required. So there was this recognition, but the state found itself kind of hamstrung in terms of its financial. So the government really was struggling to find the finances to do this, and so this probably came out just like this current monetization plan has emerged from the Niti Aayog. So it must have been a planning commission thing. But at the time, that let's go in with this public-private partnership. So this PPP model was what we chose to go with, that as the way for financing big infra projects. So what happened at this point, I think, is the PPP project, we kind of lost control of it, and the idea was, I think the idea, there are lots of merits to the idea. I'm hamstrung for cash. There are people with funds. We're going to try and partner up. I'll provide, but the way this worked out was, I think, the state trying to provide subsidized land or making it easy to procure land procurement, and using the public sector banks to provide to direct credit. So I mean, even though the banks are theoretically free to choose public sector banks about who they lend to, but because of the way they are and because of this dependence on priority sector lending goals, etc., though those operate pretty much on everybody, but this directed lending has always been one of the issues with public sector banks. That it's hard for a bank manager to say, to basically deny the request of some, politically connected or, a direct instruction that, loans have to be, given to this guy or this industry or that sector. So what ended up happening, I think, at that point was a lot of this lending, the private partnership component of it relied on easy access to land and state funds or public sector funds, public sector bank loans, which would finance a lot of it. So it led to a bit of a feeding frenzy, clearly at the time, because it just seemed like, you didn't really have to have much skin in the game. And this is where we lost control of the process. That there was a lot of lending that happened where, people just didn't, they put whatever in and took it out very quickly. So there wasn't a whole lot of skin in the game left for a lot of the private partnership component of it. And this is the sector that then began to struggle, partly because a lot of the big infra projects, it's one thing to build something. It's quite another to then run it, because the running component requires, generating flow revenues from it. So what do cash flows depend on? Cash flows crucially depend on being able to price it, price the the whatever it is that you're supplying, whether it's a toll road, or whether it's electricity generation, or whether it's gas. You have to be able to recover the marginal cost of it at the least, if not marginal cost plus, in order to defray the fixed cost of it. But that requires, pricing flexibility, that you need to be able to choose prices, and you need to be able to, collect your bills. Because if there is an issue with receiving payments, now it doesn't matter even if the price is right. I mean, you may be notionally all solvent, but you're going to become illiquid very quickly if nobody is paying. And so what ended up happening was a bunch of these infra projects ran into this kind of problem. Like, the best example of this, power distribution companies. So, I mean, these discoms are essentially bankrupt because nobody pays. And then, of course, if you've set up a big plant which is supplying electricity, I mean, if you don't, the discoms, they don't pay. So if the producer then doesn't get paid because the distributor doesn't get paid, there's a ripple effect. At the end of the day, it's the guy who produced who's sitting with, who has the bills to, he's produced he's the owner of whatever, he's the private component of the partnership of this big infra project. He has borrowed, but nothing is coming in, partly because nobody's paying for these services. So as a result, you find, these bad debts beginning to climb. So that's, what converted into, I think, a lot of these NPAs. So there are two reasons, I think, why, this snowballed out of control, or three reasons why it snowballed out of control. So the first is, of course, the fact that why don't people pay for these things? Okay, so I mean, a lot of these infrastructure related services, there is a resistance to pay, because people kind of often tend to think of this as the government this should be free services. I mean, there is this. The second reason that people don't pay is because there is, this idea that, this is a moral hazard problem, that if I don't pay, at some point, these are the big borrowers, I mean, or the big debtor, so to speak. So if you run up a massive electricity bill that you refuse to pay, if you're a big industry, at some point you kind of think, there's going to be some sort of a waiver that's going to come down the road, which is going to sort of remove all electricity. Same with loan repayments. I mean, that if you keep seeing that every election, every 4 or 5 years, there is some political manifesto that says that we're going to wipe out a bunch of loans from here, a bunch of loans from there. There are going to be loan waivers. It generates a credit culture which is not exactly in tune with the thing of, I have a debt I have to repay, but it suddenly leads into all these strategic thinking that maybe if I wait it out, then I won't have to pay. So there was that. But I think the biggest problem was the fact that, if you build infrastructure, people often use China as a great example, that China like really ramped up. And so you had all this ports and, roads and electricity and ports, everything, came up at the same time. And the state had, there was a massive infrastructure boost, and look where China is. What, we forget often is that the Chinese, model really was, a lot of sectors were, opened up at the same time. So it was not just there was a lot of infra boom, but they had a massive opening up of the economy at the same time. So there's going to be demand if a lot of businesses come in from all over the world who are setting up in ports, who are setting up factories. So they need the roads, they need the production, they need the ports, they need power. And so if you set up that infrastructure, there's going to be demand. So what matters is effective demand. You cannot just set something up when people find that, well, I have no real use for this. Of course, if you give it to me for free, I will use it. But what is the effective demand? So the effective demand is a function of whether I think this is bringing me value commensurate with what I'm going to use it for. But if I, port demand, I mean, or big roads that are connecting ports with the interior, if I don't have enough trade that has taken off, so the ports are underutilized. There's not much demand for these big roads, which people will use them if they're free. But once you impose tolls on them to cover them, they may not be, willing to pay. So I think what happened was we sort of doubled down on the infrastructure side, but that second round of reforms didn't really happen at the time. So, the economy was sort of stuck. The infrastructure was, in some sense, imagined for an economy with a much bigger effective demand. But the rest of that didn't happen. And we sort of, as a result, you had, low effective demand, low willingness to pay. And so therefore these guys, the private sector guys who had borrowed as part of the, PPP partnership, got stuck with the bills at the end, which were hard to recover. So, and of course the pricing issues. So this landscape, I mean, infrastructure investment is an interesting issue, which we keep coming back to. I mean, everybody understands that you need infrastructure, but there is a balance between them. That infrastructure, if it is, on its own, is going to be, unless it's completely state funded, that the taxpayer just funds it and says that, we've invested, we've done whatever, the government's going to pay. The rest, let the private sector respond to what we've set it up. But the moment you set the infrastructure up with private partnership, this link between how much demand there is versus, because there is no way the private sector can recover its investment unless there is effective demand. And so, just focusing on infra without opening up the rest of it, which will create demand for these products, these services that are infra related, there has to be a sync between them if one is going to use this private-public partnership. So this thing still also operates on this asset monetization plan that they've come up with now. Once again, I mean, you have to worry about what is the cash flow that's going to come out of it. That cash flow doesn't matter whether you're leasing or selling. I mean, if it's infra related, there is always going to be this issue that at what do you price it? Are you going to price it? Is there going to be effective demand or not? I mean, so that's kind of what got us, I think, into the current NPA problem.
Okay, this is quite amazing. I mean, the landscape you built for us, making us think through. And so, I mean, I don't know whether one can say that though we've had 30 years of 91 reforms, but it looks like much of our habits remain of pre-90s in that sense. I mean, we're not paying up and we're expecting some sort of a bailout and so on and so forth. Okay, so I had obviously questions, but I think we're running out of time and we can't, finish this conversation without really looking at the way forward. So in the last year, the same time almost, Viral Acharya, who had come up with his book, he had passionately argued in our conversation series that we need to maybe re-privatize public sector banks, and that proposal is already on. Then there is PJ Nayak committee, which is talking about separating ownership and management in public sector banks, and there is a whole plethora of options for public sector banks. Then RBI has recently released discussion paper on improving governance and so on and so forth. So if you could give us a quick summary of these various proposals, and how do you think we can improve the state of public sector banking in India?
Yeah, I mean, I have to, I think there are two ways to privatize banking in the country. So one is to, start selling off. So we already, I mean, the public sector banks have 40% private minority ownership, I think, on average. I mean, it'll be, I'm not sure what the latest number is, but I think the state ownership is somewhere close to 60% or something. So there's 40% has already been diluted. Now, so the big issue is, do you sort of switch to private control or not? I mean, so the state could retain, many seats on the board, but do you sort of, willing to give up operational control or not? I mean, so there is. So I think to go to the point of saying that I'm going to, just wash my hands off this whole thing by selling it off, I don't think it's politically feasible in a country like India. So there are two ways to privatize. One is to, start by ceding operational control to a few. So take your ownership down below 50%, and but retain board oversight in a strong way, but seize. The other is, of course, this bank licenses on tap. So you can privatize overall by just creating new banks. So you let these guys be, but as long as there are new banks that are coming up. So of course there was this big move that there are going to be bank licenses to be given out on tap, etc. I mean, it's shocking that despite this having been around for the last 7 years or 6 years, we've like given licenses to 4 or 5. I mean, it's so what that is telling me again is that the rest of the landscape is so is so unreformed still, that private capital doesn't see that is there money to be made here or not, because they still see too many frictions in the way things have been set up. So I think it probably might require a root and branch review, and some of it could well be that we need to rethink this whole priority sector lending approach, where if you think about the typical Indian bank, it's unbelievable that they actually make money on anything, right? I mean, the way the constraints that are imposed, that out of the first up, between the governments imposing I keep forgetting the name for this, which is with Ujit Patel had a big paper on this, where that number is now down to 19.5%, that you have to hold government securities about 90%. What is it called again? The
statutory liquidity ratio.
Sorry, SLR. So first up, I mean, out of so what are all the claims on deposits? Okay, almost 20 paisa out of every dollar is every rupee is gone on the prior, and then you come on the SLR, and then in terms of your asset distribution, the state is telling you out of every 100 rupees you're lending out, 35 of them are being, I don't know whether the number is 35 or 40, used to be 40, it's probably been brought down, but it's still somewhere around there. You already are stuck in terms of where or who you can lend to. So which is where it's like small scale, it's agriculture, it's which are all often, somewhat more difficult areas to lend in. And it contributes to also this focus on, the economies are, I think, one of our biggest problems has been this lack of large scale industry, because what the country needs is large scale industries, relatively low tech, large scale manufacturing. That's what we need. And yet our focus has our production landscape is just dotted with small entrepreneurs who are just looking for a little, very small, very niche market where people just are content with not a whole lot of growth. It's kind of small. It doesn't employ too many people. Most of these units are, hiring less than 10 or less than 20 people. So these are all very small, and the productivity is as a result not very high. If you don't have productivity growth, demand for borrowing, demand for loans is also going to be somewhat tepid. And so what you have in India, of course, these banks find it therefore much easier, given this landscape, to just hold and invest in excess SLRs. They're not even required to hold. They're holding like almost 30%. So it's almost lazy banking, because you don't have to even look very deep about where to go, because it requires hard work in order to do this. So of course, part of this has been made so easy, because you say, okay, you have to lend 40% over here into this stuff. So, and if you can't do it, you give it to NABARD, you give it to some other agency, which is, the loans, you're lending to them, or their bonds work, qualify you for this. So there are too many frictions. It's remarkable how these banks even make money. If I'm not allowed to go out beyond this, if my flexibility is so, taken out. so that landscape has to change, because there's a reason why private sector banks aren't bidding, or private sector people aren't bidding for bank licenses. So without that, selling off, I think at the end of the day, what has to happen is that these, more lending needs to go through non-public sector bank channels. And so whether that's going to come through selling off existing public sector banks or giving out new licenses to private sector, entrepreneurs, I think the latter is probably at the moment seems to be stuck. So we have no solution other than, I think what needs to do is to get this, most of these PSB ownership, public ownership below 50% and start giving out operating. But, it's the end of the day, it's a mindset that, it's the credit culture, it's the mindset that has to change, which will take time. I mean, if politicians still think through, PSBs as being a leverage that you use in order to allocate. I mean, in one of the polls that that the question I thought was excellent, which what do you think is the reason why big industrial houses? There's nothing wrong with big industrial houses getting loans. I mean, they're big, they should be. But I mean, most economies. Bank finance is mostly directed towards the small and middle. The big guys can actually move into equity finance or bond finance, which tends to be a bit cheaper sometimes than the other one. So you go through this transition, but of course you can't access the equity market or the bond market if you're not large enough. If you're too small, you can't do it. But we don't seem to be making that transition at all. That market tends to be, and you have this perverse thing that these bigger guys tend to, use a bunch of this bank finance, even the bigger guys are using. And it's, crony capitalism, you can call it. It's this mindset, which is there, that the public sector bank is essentially in the business of allocating stuff, not necessarily on market-based, on market incentives. It's based on what is the political goal, what is an influence peddling goal. And that is singularly related to ownership. I mean, if what I'm worried about is that even if control, operating control is handed over by taking ownership down below 50%, unless this mindset changes, there's going to be this constant, trying to use PSBs. So it almost suggests what Viral is saying is right, that we just have to go, and say, we're just going to cut it and cut our link. And because without that, it's going to be very hard to, it's almost like a drug addiction. It's very difficult to wean yourself off this thing that you hold, and you can, really start influencing and exerting influence by controlling the allocation of credit through non-market means. And that, is a cultural issue almost.
I think we've ran out of time. Sudhir is already telling me to keep quiet now. So maybe I'll hand it over to Sudhir.
Thank you so much. And thank you so much for this conversation. I have a lot of questions. So I would like to begin with the first question. I would like to invite Professor Sonal Yadav to come on camera and ask a question. Professor Sonal, yes.
Yeah. Thank you, Professor Lahiri, for a very engaging and interesting conversation. I have a very simple question, that is there any relationship between priority sector lending and NPAs of bank, or NPAs are more due to willful defaulters? I mean, the share of what is more, like priority sector lending is more responsible, or willful defaulters?
I think, there is this, it's a good question. I confess, I think my sense is, I have not worked directly on trying to see whether, when I think of willful defaulters, there can be, so when a bank lends to someone and doesn't get paid back, it can be for, three reasons. It could be that, the borrower just had some bad luck. Okay, so it could be that the lender did not do due diligence, so somehow picked out a bad borrower. I mean, it was, and the third one So that second one is just adverse selection. Somehow you're just picking out, poor quality borrowers. Or the third one could be that the borrower is both, has done well. There's nothing wrong, no bad luck. He's not a bad borrower in general, except that the repayment scheme is so, he thinks that he can get away, the willful defaulter. So that's the third component of, when you see. So there have been arguments made that because of this big infrastructure, that a lot of the bad loans are in the, linked to the infrastructure sector, that they got hit by some bad luck, after the financial crisis that happened in 2008. You had this complete collapse of a lot of commodity prices that happened. So people who were relying on mining or relying on, coal, so all of a sudden you had this collapse in these, so depending on what was going on with the international prices of these, you could, make an argument that there was this element of bad luck that happened around that time, because world prices of commodity prices just completely started moving way faster than anything that they had seen in the past. So there is certainly a little bit of that, but where you see that, that argument begins to fray a little bit is when you see the differential behavior of private sector banks and NPAs of private sector banks versus public sector banks. Because there was some exposure to these commodity-based industries for private sector guys as well. But what you see is, the public sector banks seeing a disproportionate, response of NPAs as opposed to the private sector banks. So it can't just be because it was pure bad luck. I mean, unless the private sector guys didn't lend at all to these infrastructure related. They did. Of course, they did. They lent less. I mean, so which of course leads to this additional question, which I was, when we were discussing with Amol, the reason, I mean, you have to ask, why is it the case that the private sector banks did not lend as much to these infrastructure, related industry, lenders than what the public sector guys did? And that had something to do with this directed lending. I think there was this push that, you should lend to them. So the answer, I think, is somewhere in the middle. I mean, of what you said. I mean, I don't know. I think there is an element of willful defaulting because people understand that they can get away with it. I mean, which they have. I mean, you could, because NPA resolution was proven despite having set up the IBC, etc. But despite that, I mean, maybe because of court interference or judgments, etc., that this process has not moved as fast as one would have liked it to. And so as a result, I mean, everybody understands, I mean, the past history that potentially you can, get away by not paying if you're big enough that you can stick it out. But that's not the priority sector lending. A lot of the priority sector lending are like these small farmers, that is not the big amount. So of the two things, I would say that, I think this business of, defaulting in a strategic way, using this non-performing status in a strategic way, and the bank's incentives not to recognize it by just evergreening them, because otherwise you get exposed that you've done poorly. This is a lethal combination. If you have a segment that is doing this, that they say that we can roll things over, and then on the other hand, you've got the bank's incentive saying, let's hide it by evergreening. Then you're going to have a snowballing effect. This keeps piling up because you're making new loans to cover things that haven't paid off in the past. So you just have this, this snowballing effect. So I think a lot of my personal sense is the biggest part of the NPAs is because of that second bit. The most of the priority sector stuff, I mean, clearly, they're too small to be too strategic, so you can say farmers, yeah, I mean, because we are constantly, around every election cycle, we are talking about waiving farm loans and so on. So farmers might do this, but that is not the big component of these outstanding loans. It is, I think there is a lot of the strategic stuff that might happen around election cycles, around these small loans, but the big component is not of the NPAs is not that. It's these big ticket borrowers, which are the more politically connected, strategic people, which I think are the cause of the big chunk of the NPAs.
Yeah. Thank you so much.
Thank you, Professor Sonal. The next question is by Devanshi. So Devanshi, would you like to come on camera and ask a question?
Yes, sir.
Thank you.
Yeah. Good evening, sir. So like in
Hi.
the starting of the session, you just had a talk about the crisis happened in the past, basically the history. So my question is that how do we can access the role of central banking in this field of anti-crisis measures in the event of banking and financial crisis taking place presently?
Yeah, so I mean, the big thing for that central banks do, at least in India, because they have the regulatory function. So the RBI does regulate banks, and so regulatory oversight is with the RBI, but that is often, I mean, the RBI can, one can say that what were you doing? Were you sleeping at the wheel, or why is it that these NPAs have snowballed and you guys were all but it's hard for the RBI on its own to kind of deal with a landscape where the RBI is also owned by the government, where the banks themselves are responding to the. So it's a regulator who is owned by the same person who has borrowed and is defaulting. At the end of the day, that's the loop is kind of complete, and so this is where a regulator that is the merchant banker to the government, which is one of the bigger, has one of the biggest, sources of the problem to start with, creates a loop that is, difficult to. And so this is why the PSBs have to be the, where you start cutting the link. You can be a much more independent regulator and a more effective regulator if you're not trying to regulate your owner, which is and that's the RBI landscape, is that because they're regulating banks which are owned by the same person that owns you. So I mean, how and at what level are you going to be truly free to do stuff? So it comes back, I think you can, of course, at the margin, do a lot of things about making bank regulations, the RBI regulators better. The RBI is actually quite effective and quite good. Examples of them going to sleep are not that many. But there is a basic problem where, how do you regulate your own owner? I mean, so if the banks are owned by the same people that own you, your ability to do this is limited. And I think that's where we come back to this issue that you just have to get these public sector banks to become a much smaller component of banking in India if the rest of the landscape, regulatory and otherwise, is going to operate in a more efficient, market-friendly way.
Thank you, Devanshi, and thank you so much for answering this in a very interesting way. Now I would like to invite Professor Supratim Das Gupta from Amrut Mody School of Management. Professor Gupta, you're there. If you can ask your question on camera.
Yes, so thank you, Professor Amartya Lahiri, for the excellent conversation. My question is that you were talking about the NPAs and the public sector banks, of course, and the whole productivity, the cycle that is probably not being, that is feeding the system. So, I mean, on the contrary, has there been any study on the welfare value of public sector banks? I mean, this is, I study energy economics. I've not gone into banking. I just thought that for a developing country like India or other countries, what is the net value of these public sector banks? Has there been any monetary value?
I don't know of a study that tries to examine the welfare, effect of public sector banks. It's a good question. I mean, there are certainly things that one can, if you go back again to this history as we were discussing it, that, a lot of people would agree with this idea that, you need to, to mobilize savings. Financial savings have to be mobilized on a more on a much larger scale. And if you're ignoring big chunks of the economy, because that's not where, because there's a bit of a chicken and the egg kind of issue. So, how do you break it? And so this is true for sure. And so that model, when articulated, now, the question that one has to ask, I think, so the short answer, I don't know of a welfare study, but clearly one can imagine that there are, you can make an argument that there is some missing market there, which, so you need to come up with a different way of allocating credit, which the private sector may not, because they're not getting returns. On the other hand, you might also ask that why is it the case that we need this, or why did the West not need this kind of approach? What is it that makes developing countries today unique, that they require this this kind of state-led approach? The second way to think about the role of some public sector involvement in credit allocation is, if one thinks that there are certain sectors, a few sectors that are potentially problematic, that we are not getting enough, you can imagine setting up very, very targeted niche kind of financial entities that are state-run. Like in the US, you have, you think the mortgage market might have issues. So you set up like these Fannie Mae and Freddie Mac, which were originally state generated, because you wanted some, you want some control over the mortgage market where households were directly exposed. So it was set up as a way of dealing with potential panics on this so you could set up very structured kinds of financial entities which are state-run, which are state-operated, but which focus only on one or two sectors and not like general banking, But that's not the route we get. So it's understandable to set up something like Exim Bank, which is doing very, very specific kinds of lending, or rural credit unions, which you sort of do to deal with. But it's quite another, I think, to consolidate the entire banking system and say, doesn't matter whether you're selling for car dealerships or lending to car dealerships, or you're lending to farmers. It's the same guy. It's like a complete, confusion of goals, that on one level, one is saying you have to, because at some level, if you think that the main, there are place sectors which will not be serviced otherwise, there you cannot be imposing profit goals on them at all. I mean, then it's like lending is going to be responding to some social goal which is clearly identified. And then there are other sectors where you say, okay, so this is non-priority, where you should operate. Moment you put both of these things within the same house, now you're expecting cross-subsidization to happen. And that's difficult.
Professor, just like a follow-up question to ask you, because you gave the example of Mexico. I actually lived in that country for a while. So I mean, Mexico doesn't have. It has government aided banks, but it doesn't have fully nationalized banks like India, I think.
No, absolutely. So what happened there was, so they privatized in the 80s. And then in the 90s, after the big, Mexican crisis of 1994, they began, so under Salinas, so what happened was they started selling them off with the stuff that they had nationalized. They began privatizing them as well. So most of these countries, when they have this nationalization boost, wave, they started undoing this about 10, 12 years later. And part of it was exactly what Amol and I were discussing at the beginning, that most of those nationalizations were in response to a crisis, some banking crisis that led to this nationalization. So once the crisis dissipated, they started unwinding, these positions. So that's why, I don't know when you lived, but starting, if you lived after the 2000s over there, you would see much presence of state
like 5-6
banking.
years ago.
Unwound a lot.
So actually, like a general question then to all of us, the audience. So like India, is it like the unique case where you have so many public sector banks and so much of the channelization between savers and the borrowers happens to the public sector banks? Is
It is pretty, I mean, the scale of it is
Okay.
I mean, so there are some smaller countries that are bigger in terms of the, total public assets or lending that is controlled by public sector banks. But, you'll find, amongst the larger economies, not one that is anywhere close to this.
Thank you very much.
Thank you, Professor Gupta. Now I would like to invite Professor Saumil Shah for his question. Professor Shah, if you're there and you can switch on your camera.
The question that I was thinking, listening to you, thanks for this nice exposition. So one is basically the cash flow mismatch problem between the long-term and the short-term firms and the directed lending. But the real crux of the problem also seems to be our ease of doing business, as we try to say, our legal system, our taxation system, which seems to be exacerbating the impacts of any economic slowdown, leading to recurring NPAs. Because when we are looking at NPAs, while we have a large amount of NPAs in the public sector bank, it is because public sector banks have large amount of lending, and most of them is towards this heavy industries where there is a sectoral mismatch in terms of cash flows because of delays, etc., which is happening. But we are also seeing a lot of NPAs piling up in other credit lending sectors. We have our cooperative banks failing regularly. We have our private sectors. You had the Global Trust, you had the IDFCs, you had the ICICI Bank, you had Madhupura Mercantile, which went bust. So unless and until we reform our basic legal system and resolve some of these issues, don't you think these issues of NPA will keep on recurring? Because, just the other day I was listening to Nitin Gadkari for NHAI. If a contractor wants to replace his guarantee, credit guarantee, which has been given to NHAI, it may take up to a year. Now, by that time, the poor guy would have become bankrupt. So what are your views on the same?
No, I agree. I mean, a lot of it is, I mean, I totally agree with you. So, this is why I was hesitant to say that, most of the defaults are willful defaulters and so on. I don't, there is a big element of that, but, but a large part is the fact that funds get tied up in, either because people aren't willing to pay or the regulatory structure is such that there is very little flexibility or there are massive holdups that happen. So all of those. So as you said, I mean, if some you cannot, if applications for small, simple things take that long to get processed, the operator will get into problems. So I think there are issues which are, up and down the entire, up and down the entire economic landscape. So, there is no doubt that we need a much more root and branch, revamp of the way. So, ease of doing business, clearly, I mean, what you're suggesting is there is way more control than there needs to be. I mean, let's put it this way. So, and the state, I've written about this in the context of, other, I think the state has imagined itself to be more central to the economic life of its citizens than it should be. That it is an overestimate of its own ability to what it can do. And so I think it is, what you're saying, I'm completely sympathetic to it, that the state has to view itself as in a much more, how should I say this, self-effacing way, that its capacity is limited. It should allow the, private enterprise to kind of seek its way, just limit itself to basic regulatory functions, not try to do too much, and not try to over-regulate the economy, which our command and control mindset, even though a lot of the reforms have happened, but the command and control mindset has not completely changed. So every now and then you see some sectors where you suddenly see things have become a lot easier. But when you talk to, for example, I mean, how people like you or me, I mean, I can see some things have become a lot easier where you don't have to go through even simple things like getting driving licenses and getting those things seem to have become a lot easier. I mean, but on the other hand, if you talk to small producers, I mean, it doesn't seem like things have changed much. I mean, even if you're in, in an operating an industrial park right out of Nagpur, even navigating small little things involve, going to the DM's office 4 times to try and get, So yeah, so I agree that the regulatory landscape has to be, the state just has to retreat from a bunch of things it is involved in right now. And over-regulation is clearly one of them.
Because, I agree with you completely that the easier picking has been done as far as reforms is done, but our core sector reforms is what has not happened. Just take the case of Mr. Birla. He started Birla AT&T. If we look at the telecom sector, which is one of the big problems that we have in infrastructure tangle, in 98, and in 2021, he is willing to give up his share for 1 rupee. An industrialist is not wasting his time for 2 decades trying to build up a company, and then we say that he is anti-national or he's trying to, give up, and then you have social media outbursts going against him. But then the structural flaw in terms of the license design, etc., is so huge that it's difficult for people unless and until, of course, you have right connections. And we all know what we are talking about, that it becomes difficult for a genuine operator to operate.
No, I totally, I could not be more sympathetic if I tried to everything you just said. I completely agree. This, and there is this, along with the fact that there's over-regulation, there is this aspect that there is systematic relaxation which is even worse. That,
I would say selective relaxation. Not systematic, selective relaxation.
Selective relaxation, which is that you got the right word. I used the wrong word. It's selective relaxation. And which, if it's an even playing field for everybody, it's one thing that, there is overregulation, but, there's overregulation and there's selective, ease of doing business, which is a very bad combination because, and we are. So India, I think, needs root and branch reforms across the spectrum. So our discussion was clearly on banking and NPAs, but the system itself has huge bottlenecks, and a lot of them are regulatory in nature, which is we have not been able to change it.
Yeah. Thank you, Professor Amol, and there is a request, Professor Amartya, because there are a couple of questions by MA Economics student, and I know that our time is up, but I would request for 5 more minutes, and we can have our question because they're very keen to ask. So I would like to invite Ayush Kumar from MA Economics. Ayush, if you can come on camera and ask a question.
Yes, sir. All right. So, sir, actually, I have been reading Anti-Fragile by Taleb, and he was actually arguing that as the system becomes more complex, the output becomes non-linear. So I was thinking about the banking system right now, that it has become more complex, and how banks are interdependent on each other. And the concept of too big to fail has come out. But my main query is that, is it a good idea? Because as the banks are becoming bigger, the impact of their failure will be becoming more convex to the origin. So is it a good idea to regulate the too big to fail bank entities, or should we not be allowing any bank or any companies per se to become that big that it can influence and impact all the economy? And my second question was, as we talked about the regulation, that RBI under Section 7 is actually under government. So the Bank Board Bureau is coming up for selection of bank board. And my again query was that how can we actually make sure that politicians don't interfere even in that sense? And there will be again a backdoor for a politician to intervene and make his person chairman or anything like that, and the whole system will again mess up. So how can we actually make policies regarding that, or will we have to actually wait for the politicians to come in the parliament and make something like that?
So to take your first question, it is true that as economies get more, more developed, interconnection, the network structure becomes much more, interlinked. So, different. So you start seeing, even global supply chains have gotten so interlinked that what happens in one sector can often start impacting other sectors. Well, I think that is just in the nature of growth, that it is this systems become more complex. So I think that bit, does it necessarily lead to increasing fragility, or does it lead to increasing risk diversification? So there are two things that happen. So if I'm relying only on one person for everything, I'm just linked to his fortune. If this person fails, I fail. If this person does well, I succeed. On the other hand, if I'm dealing with lots of different people, I'm much more diversified. On the other hand, I become much more exposed at some level, because things that happen very far away from me can start trickling through the system. So this network theory is an interesting, it's an unfolding area of work, which is very interesting area actually. But there are two forces there as to, does increasing complexity through these networks, does it create more stable or less stable systems? Because on the one hand, you diversify, on the other hand, you become exposed to shocks which are very far away from you, simply because through the network. And so this is a sort of an open question. There is the answer is not that clear yet. People are working on this, trying to understand, does it make things more stable or less stable? So, but it's a good question to think about. In terms of too big to fail, though, this has been on for the, going on for the longest time. And it is also linked to what kinds of competition committees do you have, or who are regulating mergers, who are regulating, are you allowing certain mergers to happen, or you kind of push back and say you don't want them? So in other words, that's about trying to regulate size, that you don't want concentration of ownership where, in some sector, all of a sudden everything goes down to two operators and nobody else can survive. And that is usually well before anything else. It's mostly about trying to prevent monopolistic, tendencies to emerge within sectors. And so that's where the competition bureaus have to really get to work. So before you get to that point, so that one, so I think the problem is deeper than just too big to fail. The problem is all about, are you creating conditions where competition itself is getting eroded by generating so much concentration that, yeah, the system can become very dependent on these persons, but it can become also very restrictive, that all, if you only have two operators operating there. So I think the first thing is, you should not get to this point, and the competition bureaus have to be the people who push back and try to make sure that this kind of concentration is not allowed to happen. And I think there is great awareness of this, but this is where oligarchs emerge through this kind of, these kinds of forces as well. So it's important that, that every country's, competition bureaus actually work to prevent that from happening, because beyond the too big to fail, there are other issues that happen in this. I've forgotten your second question. Your second question was...
Sir, it was regarding Bank Board Bureau. The autonomy of Bank
Bureau, yeah. No, so that I think the answer is what we were discussing earlier, that as long as you've got, nobody's telling HDFC whom to appoint as its MD. Nobody's telling, any private sector bank whom to appoint. So at the end of the day, what has to happen is this, public sector banks, their ownership and management has to become more market-based, cannot be this centralized take on things. And so until that happens, I mean, you're going to see, political interference, because anytime you're appointing somebody to some publicly owned entity, you're going to exercise, there's going to be, futile to say that there's going to be no political, there should be no political interference in when you're trying to appoint somebody to a public sector, banks, management, because it is publicly owned. So they are going to be exercising some say on it. This is where, I mean, this being in this twilight zone of like saying, on the one hand, you have to deal with social responsibility. On the other hand, you have to, respond to market incentives. It's very hard to survive in this kind of strange world, because it's one thing to say that, okay, this is your goal, this is what you're a private sector entity, this is what you go after. I'm just going to make sure you don't get, you don't steal, you don't cheat, you don't unfairly drive out other businesses and so on. So that's all I'm going to try and do. That gives clear incentives, and there is no mixed messaging, mixed, conflicting objectives, because there's nothing worse for a business than to have conflicting objectives. And so what has happened in a large part of our landscape, at least in banking, is there are conflicting objectives. I mean, so when you have that, you're going to have potential problems. I mean, so bank boards and appointing people is part of the same problem. That what exactly are you trying to achieve?
Yeah, thank you, Ayush, and thank you for this. I have last couple of questions, and I'll put them together. There is one MA Economics student, and Khushali, she has a question. What is the state of public sector banks with ESG financing? And do you think considering ESG risks will help with the NPA issue in the future? And there is another question that I saw in the chat box. Anil Pandey was asking, can you suggest some topic for research in current research in economics? I don't know it is possible right away, but can you suggest a good book to everyone so that people can read and benefit from this? Any recommendation from you? So these are the last set of questions.
Let me think about if there's one book that people should read in terms of, I mean, I find this most like a very interesting read in trying to understand. I think development is, I mean, we often respond to short run things, but development, I think, is one of the biggest challenges that, as a profession, as policymakers, as analysts, everybody faces. I mean, there's things about business cycles and so on that everybody gets very excited about, at least some segment. But, these things about dealing with, fluctuations, quarterly fluctuations, while, it captures the press. But in terms of welfare, it's of almost second order importance relative to trying to deal with these first order things. So a lot of the discussion today that, highlighted the biggest impediment to development is structured around the institutional framework within which countries operate. So what determines this kind of institutional structure? That how have some countries been able to change stuff? What has, why does the West operate the way it does? How were they able to, get out of this crony capitalism? I mean, there was robber baron, there were all of that stuff was going on in the late 19th century, early 20th century in the US, but somehow they got out of it. I mean, and what allowed that transition to happen? So it's hard to say one book, but definitely if this book by Daron Acemoglu and James Robinson is something I would recommend to everybody, which is all about the institutional history of what, which set of institutions seem to do better, and what kinds of prior conditions, put those kinds of market-friendly institutions in place, and what can we learn from. So I think that is a good starting point because I think without forming a sort of a big sweep perspective on sometimes we get caught in very sort of high frequency, what happened over the last 2 years, 3 years, 4 years. and it doesn't give you a complete perspective on what. So for those interested in research, I would really say to start with that book. I mean, that Daron Acemoglu and James Robinson, that is a good book to start. To ask why are we the way we are, and how important are institutions? Because in India, for example, institutional reform, I think, is the biggest challenges, as Professor Shah was pointing out. So I think that's what I would say. I confess I don't know the answer to the first question that was asked, because I don't know what that thing was. That what is ED? I don't know what that is.
ESG. So if Khushali were there, if you can explain
Environment, sustainability, and governance. Those.
ESG. Yeah, this is what she meant.
So actually, I mean, if I can answer that.
Yeah, go ahead, please. Yeah.
No, so essentially, as we are talking to Professor Amartya Lahiri, maybe Khushali can read up Professor Ashwath Damodaran's recent take on ESG financing, and he's absolutely done away with the concept, trashed the concept. So Khushali, in case you're there, you can, because I mean that ESG financing is still in its infancy in India. We still don't know much about it. There are discussions about it, but in terms of the concept and ESG as an approach, I think Professor Ashwath Damodaran's very detailed post on this is a great read.
Thank you so much for this, and I would request Professor Amol Agrawal to have a closing remark quickly, and then we can wrap it up. It is the dinner time here, Professor Amartya, so people are waiting for that. Yeah, Professor Amol.
Yeah, Professor Amartya, this was great. Hearing you and meeting you virtually. Hope to catch up with you sometime when you're in India, and do pay us a visit. It was really fun talking to you, getting this whole landscape of Indian banking history and policy reforms. I think we really covered a fairly vast landscape in a very short time. So thank you so much. In case whenever you are here, please drop by Ahmedabad, and so thank you.
No, thank you very much. It was an absolute pleasure. I mean, to chat with you and to interact with so many of you. So, I do, as some of you might, I have told you earlier that actually, I did spend some time in Ahmedabad many years ago, and I have very fond memories of it. So definitely, next time I'm in India, I'll try and pay a visit. I just, it's been almost 10 years since I last went to Ahmedabad, so hear lots of great things about the place. So anyway, thank you again for having me. It's an honor and a pleasure.
Yeah, same here, and thank you so much, Professor Amartya, for this. This was so engaging, and we were listening to it, and a lot of questions came. And as I always say, that the question answer session is the main session. There are a lot of people ask questions, and then we get diverse views. And thank you so much for recommending that book. And we are grateful to you for this, and we would love to have you on the campus if we ever get an opportunity. Pleasure is all ours. And thank you so much, Professor Amol, for having this conversation. And thank you so much, everybody, for joining to such a time, 6:30 p.m. to 8 p.m. in India. And nothing more than this. So grateful to all of you, and see you on our next conversation series webinar. And take care, Professor Amartya.
Thank you very much. Bye-bye, everybody. Thank you.